This is our agenda today. Now, Cos is going to be guiding us through some of the key reinstatement cost drivers. So very much an update from the previous insurance focus webinars we've done, where the overarching message has been around significant materials cost inflation. So an update on how things are looking now and what we should be looking out for in the year ahead. Then following that, I'll be exploring some of the main causes of underinsurance that we can see. Cos will consider what we see as good and less good practice around indexation and index linking. And James, hopefully, will join us in time to highlight some of the key issues around carbon and sustainability developments. Now, finally, we'll be pulling all of that together to look at how we might address some of these challenges with customers and clients. And hopefully, after all that, there will be some time for Qs as well. We will try our hardest. So just a flag, we're also going to be sending out a crib sheet after the session with some practical guidance on the issues that we'll be running through. So keep an eye out for that. If there's anything that you would feel would be particularly helpful, especially when it comes to speaking to customers and clients, to explain in a really straightforward way why the sum insured getting it right in the first place is so important, please do let us know in the feedback survey too, and we will try our best. Okay, so before we get into it, and before we get into the detail, I just want to start with framing a point. Now, which sits behind almost everything we're going to talk about today. So particularly as I know we've got a real mix of professionals on the call today from different parts of the built environment, and that is risk perception. So because when we talk about reinstatement costs, underinsurance and indexation, we often treat it like a technical question, really as if it's simply a matter of having the right data, applying the right index and keeping everything up to date. But the thing is, in practice, we all know it's rarely that straightforward, because the sum insured means different things depending on where you sit in that process. So for a policyholder, it might be, what can I reasonably afford to pay? For a broker, it might be, what will stand up if there's a dispute? For an insurer, it might be that the true liability we're taking on and how does it stack up across the book? Now, for a claims team, it becomes what happens when this number meets reality. And then finally, for surveyors and cost consultants, it's often simply, what would it genuinely cost to rebuild this building today? All of those perspectives are rational, but the challenge is that we don't always point to the same direction and the risk isn't evenly shared. And that's why reinstatement costs and how you arrive on that sum insured matters so much, because when things go wrong, it's not just a technical issue. It becomes a commercial issue, a customer issue, and in some cases, a regulatory and reputational issue. So as we go through the webinar today, we'd encourage you all to keep that in mind, really. So not just how you think about reinstatement cost risk, but also how your clients and your customers think about it. Are they being based, they're sent on risk inflation headlines or what they've heard in the media, for example? Are they assuming that index linking means the number must be right? Are they more concerned about the insurer increasing their premium than they are about the consequences of being underinsured, which is a common feedback we hear? Because those perceptions have a real impact on behavior, and they help explain why underinsurance can persist even when the tools to prevent it exist. Okay, so with that in mind, we'll start by looking at what's driving reinstatement costs in 2026 and how that differs from the inflation narrative we were talking about just a couple of years ago. So without further ado, I'm going to hand over to Cos.
Thanks, Rich. So before we actually dig into what is driving reinstatement costs, let us revisit and sort of redefine what we are referring to as rebuilding costs. What actually goes into the rebuilding costs? So rebuilding costs for insurance purposes, we are looking at the total cost of demolishing and clearing away the existing structure. This includes any substructures and any other surrounding stuff, and rebuilding the structure to the original design and standard equal to the existing property. And above all, it has to be in accordance to the current building regulations and other statutory requirement. It also includes the making safe of damaged and adjoining properties. This is mostly applicable to attached properties. It also includes the professional fees in connection with the rebuilding, including local authority fees and other taxes, VAT, where it is applicable. So the key note to remember, it is not about the bricks and mortar only. It is about all the other things surrounding the reinstatement of the property. Next slide, please. So to help us with that, I just want to share some of the things that BCIS provide to the industry, or the tools BCIS have for the industry, and how those tools derive the data they have. For the BCIS Protects package, we have, or it includes, the residential rebuild calculator. This is used mostly by surveyors, and it is based on about 1,200 dwellings. These are buildings and flats, and 600 ancillary models, which include things like garages, conservatories, driveways, and drainages. These are priced using our schedule of rates, which is also included in projects in most of the packages. And this has up to 12,500 supply, prices, labor, and plants. These are updated on an annual basis. And then these cost models, once they are updated by the supply prices, they are adjusted for market conditions. For this, we add the profit, we add the prelims, we add all the prevailing market conditions. So it is, the rebuild cost is not only about the input costs. So the costs reflect current design practices, modern methods, and materials, and we allow for period features. This applies to buildings or to dwellings which are, so let's say, built in the pre-war dwellings, and even the Victorian and Edwardian features. So why is this important? Those houses will have features like high floor to ceiling heights. They will have on-it features in them, and some of them still have very expensive fireplaces. So that add up to the rebuild cost, and that might be different from modern housing. As said before, it includes demolition costs and supporting adjoining structures. The one thing which is important about rebuild costs is they respond immediately to statutory changes, as opposed to other data sets. This is because you are looking at day one, you are looking at what would happen on that day when you go for planning, when you are trying to reinstate that building. So it is not going to wait for a long period, because you are reinstating that day in that period. For non-residential properties, we use average prices. These average prices, again, in our Protex and other packages, these average prices represent actual analyzed tenders which have been received in the industry. And our database now contains over 30,000 analyzed projects. This represents average costs of similar facilities, as we classify our buildings based on the function, and it reflects how that function affects the cost of a similar building. Again, the costs here, they reflect current design practices, and they are mostly modern materials, and they are mostly modern buildings. Unlike the rebuild data, there is usually a lag in reflecting changes in regulatory changes. This is mostly because we analyze data which is actually accepted for tender, and that takes a little bit of time for it to get to us, and then it is reflected in it starts affecting the average prices to include the changes in regulatory changes, especially building regulations. We also have the tender pricing index, which is commonly used to uplift reinstatement costs. We also have other tools which we haven't gone into here, but these are the main tools which you can use for coming up or assessing a rebuilding costs. Now, coming to the current and actual drivers of rebuild costs. We have had an elevated material prices and labor costs over the past few years. This has been well documented, and we've had several webinars on this. We've had several regulatory and compliance uplifts, and we've had the growth of specialist and proprietary building systems. These include air supply, air source heat, air source heat, what are they called again?
Heat pumps.
Air source heat pumps and all the M&E things. Yeah, I'm having an older person there. Again, over that same period, we've had rising prelim costs, and we are going to go and dig deeper into these and the climate related issues with extreme climate conditions going on. And to illustrate this, Rich, next, we came across this article from a City of Manchester Council press release. This was given the council's explanation of how a £95 million cost overrun, budget overrun, and delay of the completion on their town hall to refurbish this project. Although this is not a reinstatement project, the challenges cited by the council illustrate the pressures on the construction cost over the past 5 years. So what did they actually cite in their press release? They cited the pandemic, and we know about all this. It actually reads like a sort of a bingo game of potential issues which you could find in any reinstatement costs or in any project over the past few years. The pandemic disruptions, which in turn led to a very volatile economic climate, the war in Ukraine and other disturbances throughout the world, unprecedented, which led to unprecedented material and labor costs inflation. They also reported shortages of specialist labor and capacity in the supply chain, which in turn led to a higher cost of labor. They also reported that 3 contractors on the project have gone into administration in the past 6 months. So these are sort of common things which you can find on most construction projects right now. In fact, the construction sector experienced the most insolvencies, more than any sector in 2025, with up to about 16% insolvencies there. But when you look at the items on the right, they might be more applicable to reinstatement projects. They might be applicable especially to listed and heritage buildings. Especially when you look at the 3rd and 4th bullet point there, the issues with the supply of materials under strict heritage rules. You need to closely match the materials. This can be a little bit difficult, especially when you're looking at materials like stone, where quarries for particular material or for that particular stone might have closed or might have ceased operation, and you might have to look further afield to get replacement material. This in turn has a knock-on effect on the delays on other trades. So yes, the most important thing there to remember is, again, we are not in isolation, we are working as part of the industry. So moving on to the actual movement in prices. Back in 23 and over the past few years, we've been reporting on webinars on significant inflation and price increases on materials and labor. This is a chart which is showing the BCIS materials cost index over the past few years. As you can see, we had a spike there in 2023. This was a direct result of the disruption in the supply chain in 2022 due to the pandemic, and also the disruptions caused by the war in the East. So we had a spike in material prices there. That graph is showing the annual inflation, that is the change on month on month in prices. Although it is showing that the change has come down, in fact, we moved into negative territory on some of the materials in the past few years in 24. But now material prices are still going up. Now, we have to distinguish between the rate of inflation and the actual increase in prices. The actual increase in prices has not, the actual cost of the materials has not come down. It is just the rate of increase. So if we move on to the next slide, we will see that if we look at the BCIS material cost index, which is red, it is showing that the cost of materials has stayed up. Okay, there was a little bit of a decline in 2023 there, but it has stayed up. It is still higher than it was in 2009. So even after the crash, so the cost of materials is still very high. It is the actual movement which has come down. And we can see the green line there that in 2025, the cost of materials is once again ticking up. But rebuild costs and construction is not only about materials. But before we get to other materials, let's look at what has been happening to individual prices. Can you move on to the next slide for me?
Yep.
So if we look at what has happened to the material, to individual prices using the PAFI Series 3, we can see that most materials went up in 2022-23, with things like reinforcement going up there at about just under 50%, peaking in 2023. The same applies to softwood and copper pipes. However, other materials like insulation continued going up steadily and actually peaked way later in 2023, where they are probably mostly affected by things like energy prices there. And other materials like copper are now going up. Copper prices are going up again, driven by the demand for commodities like gold, and also the demand in other industries like AI and all this push towards moving away from fossil fuels. Brick prices have remained steady all throughout that period, although they peaked again in 2023. Again, if we look at the next slide, we will find that based on that very same series, there are 65 indices in the PAFI Series 3. And of those series, I've picked the 5 examples of material prices which have gone up by double digits over the past few months, over the past 12 months. These again include copper, zinc, aluminium, and things like scaffolding. In fact, 39 of those indices have gone up by more than 5% over the past 12 months. Right. But the industry is not about materials only. We also have had pressures in labor costs. So moving on to the next slide, we will see that labor costs have been the main driver in the past few years for inflation. Although material costs there in red were going up at a much higher rate in 2022, peaking at just under 25%. Labor costs kept going up, especially in 24-25. They kept going up and at a much higher rate above inflation. Labor costs are currently the key inflationary driver in construction, again, largely due to earnings in constructions remaining higher than inflation. There are a few reasons for this, which we are going to explore, but we're expecting labor costs and material costs generally to go up by another 15% in the next 5 years, over the next 5 years. But from that graph, you can see that we're expecting that material prices and indeed labor costs have stabilized or will stabilize over the next few years. Okay, if we move on to the next, sorry, excuse me. Have it. The next slide. If we take a closer look at what has been happening to labor, you can see that our labor force has been shrinking over the past few years. And UK construction force has declined by over 300,000 over the past 20 years. The decline is also very pronounced in the self-employed. The number of self-employed has declined over the years. This has an impact on the flexibility of contractors to respond to changes in demand. So why this is happening, we are not so sure, but it might be issues around Brexit. What happened is a direct result of the immigration arrangements we have with Europe now, the pandemic, the aging workforce, and people not returning to the industry after the pandemic, and also generally with depressed demand over the years, people leaving the industry. However, what happens when the industry or when demand peaks, we are not so sure how the industry is going to cope, especially as the demand for air source heat pump engineers, I got it right this time, and other green collar workers, other green collar workers, as they're going to be called now, demand increases. There's going to be a need for training and more specialist engineers in this industry. So to gauge the movement in tender prices, BCIS also engaged the industry. And in one of the questions, we asked our TPI panel what is happening to contractors' declared profits and overheads. We noted that over the period from 2022 to 2025, they declared that the overheads and profits were between 5.1% and 5.7% over that period. At the same time, the BCIS tender price index has increased by 16% between that same period. It has increased by 16%. So you can see there's a bit of a squeeze on profits on the contractors in real terms. Right. So looking further afield, what is really going to be the main one before, Rich? Go back one, please.
Oh, apologies.
Yep. Looking further afield, we just looking at the key drivers for 2026. We are expecting, we've seen some positive signs of growth where we have a report of an increase in construction orders in 2025, which means that we expect the pipeline to be improving this year. So there's going to be a bit of a positive push, positive news there. There is a bit of stability, as we said, in input costs over the years, and we've looked at the shrinking workforce. But what is also happening is we have an aging housing stock over generally in the UK. We have some of the oldest buildings, oldest houses in Europe. Actually, about 20% of the dwellings in the UK were built before pre-1919 Victorian Edwardian houses, and that number is actually increasing. The number of homes is increasing over the past 10 years. We've increased that number. This is strictly because of conversions. We are converting some of the old historic buildings, and they are coming on the market as new dwellings. But what it means is that in the age of extreme weather conditions, these dwellings are more susceptible to weather damages, and there's going to be a lot of partial loss going forward. We are also expecting a lot of regulatory changes going forward, which are going to be linked to the drive to net zero. Specifically, we are looking forward this year to future home standards. So this is sort of to summarize what we expect to be happening and to be driving reinstatement costs in 2026. Thanks, Rich. So to have a sort of long-term view, especially looking at regulatory changes, construction costs, and I did update this slide, which I shared in the 2023 webinar. Construction costs, they follow the same cycle as the building cycle, the economic cycle, where whenever there's a crash or there's a recession, we find that construction costs will decline. So the blue line there is actually showing you the changes in rebuilding costs as measured by the House Rebuilding Cost Index. And the pale light line is showing the CPI inflation, which has been joined with the RPI because the CPI was only published I think it was when it started published in 1989, around there. But the most important thing to take from this is that regulatory changes, which are in red there, will result in changes in, or will change, or will result in inflation in rebuilding costs. This, for example, in 2020-22, there was a 5% increase in rebuilding costs due to changes in Part L and other related building regulations. And we're expecting further increases this year, or changes in the future homes standards, which could increase the rebuild cost by another 5%. I think that's it from me, Rich.
Brilliant, Cos. You can finish your water now. Thank you. Great. And also, I've noticed James has managed to join us. Good morning, James.
If he can unmute himself. Good morning. Good morning, everyone. Apologies. Apologies for being for being a little bit late.
No, that's great. We've just been keeping everyone warm for you as you arrive. So
Thank you.
Brilliant. No, yeah, thanks a lot, Cos. So now we're going to take a look at some of the top causes of underinsurance that we've seen as BCIS. So common cause of underinsurance is confusion between a property's market value and its reinstatement costs. So the market value reflects location, land, and demand, whereas a sum insured should reflect the full cost of rebuilding the structure at today's price. So that needs to include things like labour, materials, preliminaries, professional fees as well, and the compliance with current regulations. So what we have actually seen, there were periods where these two numbers worked quite closely, and with those there was rules of thumbs that may have appeared to work. One of them I'd managed to see on a social media group, which was market value plus 20% outside the M25 and market value plus 35% inside the M25. These kind of old wives' tales are very much around. However, divergence driven by land values, regional demand, and construction inflation has made that approach highly unreliable. So where the starting figure is wrong, every subsequent renewal compounds that error. So, this one's quite a good one. So even when the sum insured was once broadly accurate, it can become inadequate if not reviewed regularly. So construction costs have experienced periods of sharp volatility in recent years, driven by materials inflation, labour shortages, and the regulatory changes that we've had to deal with. So if the sum insureds are only just adjusted incrementally at renewal point without a fresh assessment, they can fall materially behind the actual reinstatement cost. Now, underinsurance in these cases is not a result of a single miscalculation, but it's more of a gradual misalignment between real-world build costs and static policy values. Now, there is also a drift as a consequence of properties changing. So especially through the pandemic, we've seen a large increase of extensions, loft conversions, basement works, upgraded finishes, or external additions all increase the reinstatement costs. Now, if those changes are not reassessed on a formal basis, the sum insured may continue to be uplifted incrementally from an outdated baseline. Okay, so inappropriate use of indexation and index linking. So index linking is designed to maintain adequacy between reviews, but it's not a substitute for getting the starting valuation correct. If an initial sum insured is underestimated, applying indexation onto that supply simply increases an already inadequate figure. So in addition, the index used must reflect the cost as relevant to reinstatement, not general inflation. So inappropriate reliance on automatic uplift mechanisms, particularly on over long-standing renewals, this basically can create a false sense of security while materially distorting the true rebuild value over time. But we'll come back to indexation and index linking shortly. So underinsurance frequently stems from incomplete, outdated, and aggregated asset data. So we've discovered in portfolio cases, portfolios may be insured as a total book without reliable granular detail. And also details on size, specification, construction type, or subsequent alterations. Now, even if a single property case's improvements and renovations are not always captured in underwriting systems, long-standing rules can reinforce that if the emphasis is on a premium continuity rather than reconfirming property detail, where material changes are not recorded or reassessed, the sum insured no longer reflects the asset as it actually exists today. And without accurate and stored property data, setting an appropriate sum insured becomes materially more difficult. So price sensitivity remains a strong behavioral driver in personal and portfolio insurance. Consumers often prioritize premium over adequacy and may interpret detailed valuation questions as upselling rather than actual risk management. So this creates a tension across the distribution chain from surveyor to broker to underwriter, particularly where technical explanations are difficult to communicate in simple terms. If the importance of rebuild cost, average clause, and indexation is not clearly understood, underinsurance can emerge through a combination of risk perception, easy for me to say, gaps, and limited engagement with policy detail. Okay, and just to reiterate the point, this is one of the questions taken from the FCA's Financial Lives Survey, which was conducted in 2024, and it was published last year. And it will probably come as no surprise to see that just 1/4 of respondents to this question on reading the policy documentation said they had actually read it carefully. Now, of course, not every complaint about building insurance will be down to underinsurance, obviously, but it can be one of the factors, particularly where a policyholder only discovers a shortfall at the point of claim. So for the customer, the impact is obvious. If the sum insured isn't adequate, they may not receive enough to fully reinstate that property. So for insurance, the consequence can be extend beyond the individual claim. Complaints can lead to higher handling costs, pressure on customer satisfaction scores, potential regulatory and reputational risk as well. So even where the policy has been applied correctly, disputes around cover can affect trust and confidence in the market more widely. And on that note, hopefully you've rested your voice, Cos, so I'm going to pass back through to you. And then we're going to go through some of the key principles around the uses of indices. Oh, Cos, I think you're on mute, sorry.
Sorry.
Right,
Yep. As Rich mentioned earlier, some policies and good policies make provision for the sum insured to be increased in line with a building index or an index of some sort of insurers' choice. So how do you actually choose an index? So we're just going to go through some of the golden rules of choosing an index we have come up with in BCIS. Right. The first rule is be clear what you want to measure. So the objective in insurance is to measure the movement of cost of reinstating a completed building at current market prices. It's not the consumer inflation, not the contractor's input costs, not one volatile material. It is the cost of reinstating. For residential, we mean the cost of rebuilding the house. And for commercial properties, it means the market price of delivering a comparable building. The second rule is to choose an index that most closely matches that requirement. There are several indices. Actually, BCIS publishes thousands of indices. So you have to choose the right index. For example, the ABI BCIS House Rebuilding Cost Index measures the movement of cost of rebuilding houses. So it is reflecting the cost of the whole house. It's specifically designed for the insurance industry. It is not designed for private house building. It is for the insurance industry. And it is actually recognized by the industry, and it is used by the insurance industry for most index linking. But other indices exist. CPI, for example, it measures household consumption. That's not suitable for most of what we are looking at in building costs. A material cost index only, we looked at material costs before. They measure the costs of materials, etc. So there are so many indices available. Choose the appropriate index. For non-residential indices, there are for non-residential properties, there are indices like the TPI, which might be appropriate for that index. So next slide, please. Ensure that the index you are using has the required frequency and contractual suitability. There are some indices like the SEAL index, for example. It is published annually, and yeah, it's suitable for that. But for house rebuilding and TPI, they are both published regularly, and they have been published. They've got a pedigree. Have been published for a long time. They meet the governance requirements expected of insurance indexation framework. They are transparent, and they've got clear revision policies. This matters particularly under the consumer duty. If some insured are automatically uplifted, the index must be appropriate, transparent, and it must be defensible. And for that, you need also the next slide, please. You need to understand the methodology, how that index is compiled. For example, the House Rebuilding Cost Index is based on a survey of mentioned prices, but resource cost indices, they reflect the factory gate prices of the inputs. So you need to understand where your index is. So the house rebuilding cost is suitable for a one-off rebuild cost, whereas the other resource indices are measuring the input costs of the industry in general. Reinstatement costs are also not only exposed to labor materials, but the prelims. You've got to look at the contractors' overheads and profits, etc., in there, which are included in every index. So for you to understand the methodology, I think you need to read the notes and definitions which accompany those indices. Next slide, please. For residential index, for example, for residential properties, the house rebuilding cost is explicitly designed for rebuilding, as stated before. It aligns with insurance reinstatement cost assessment practice. Excuse me again. Water. And if you look at the TPI, it is reflecting the tendered building prices, the movement of tendered building prices. The TPI covers all sorts of buildings in it, whereas the house rebuilding cost is specific for building. Choosing an index outside its defined scope creates a drift, and there's a risk over time of under or over insurance. And lastly, never choose an index based on its past performance. I think this was very common when people used the general building cost index because it was a steady index as opposed to the tender price index. But in volatile markets, there can be pressures to select a less painful index. This is a wrong test. And the correct test should be, does the index measure the movement of cost in restating the building in question? And yes, in short term, short-term volatility is not a reason to abandon an index. All right. Let's just quickly look at examples of good practice and poor practice. Rich has gone through some of this before, but there must be a clear separation between the valuation or the assessment and index linking. You have to have a time when you actually index, you assess and establish a baseline for that index. You must use an index that matches the exposure. The index must be the appropriate one for residential. For example, we said the house rebuilding cost index, and the TPI for commercial. Once you have chosen an index, you must be transparent and you must communicate with the policyholder in the wording on how that index is being uplifted or has been uplifted or is going to be uplifted. And go on ongoing monitoring and recognition of abnormal conditions which can happen. Poor practice include index linking over a long period of time. The RICS encourages that you should assess from first principles every 3 years. And during the time of volatility, it might be actually better to do it more frequently, especially we saw what happened during the pandemic period. And at times, people can select indices based on premium sensitivity, and not necessarily because of what it is actually measuring. Using outdated indices or not using indices that reflect actual reinstatement costs can also be very poor practice. As Rich said, we must have ongoing monitoring. A set and forget approach is not advisable. You have to always look at the index and look at what is happening to the market, and never imply that index linking guarantees adequate cover for cover, because index linking can only work for a short period of time. If we move on, Rich, I think we've looked at all these indices before, especially the house rebuilding cost index. As you can see, over the past 5 years alone, the house rebuilding cost index has gone up by 227%. Whereas if you had used the CPI, for example, you would have been at 95% increase, which could be off by up to 100%. So I'm going to leave it here for now, and we'll come back to this later.
Brilliant. Thank you, Kos. Kos, I'm also just going to say, I think the next time we do one of these webinars, would I be right in saying that we'll probably have our partial HRCI to show in this graph as well?
Yes, that's what is happening. And as Rich is saying, we said the house rebuilding cost index is for whole buildings. So for in the future, we are going to come up with an index for partial loss, especially in line with these extreme weather conditions we're experiencing. And we know that insurers are having to address partial loss and the inflation in that sector.
Brilliant. Well, heard it here first, folks. So we will update everyone once this is ready. But I know Cos has been working around the clock to get this prepared. So great. Okay. So without further ado, I'm now going to pass over to James to cover reinstatement cost and carbon.
Thank you very much, Rich. Can I just check? This is a 2-hour webinar, isn't it?
It is 3.5. Yep.
Yeah.
I am, unfortunately, we're very pushed for time. I did pre-warn. We've got a lot of content, so yeah, sorry, folks. We will pick up your questions afterwards.
Yeah, and obviously a reminder of what Rich has already said. There will be a recording of this if people do have to disappear at the allocated hour. I personally won't take it too personally to see those numbers drop down as soon as I start talking. But yeah, great to be here. Thank you very much for including me on the panel today, gents. It's an honour to be here. Apologies that I'm slightly shadowy in terms of the video. And again, apologies for being a little bit late to the party as well. So I think there's a few bits that sustainability related, perhaps rather than just cost and carbon, that are on the horizon that are probably already having or soon will have an impact on the insurance industry and reinstatement assessments in particular. That's probably worth discussing today. Some of them have been touched upon, so thankfully Cos and you, Rich, have done a brilliant job there that I'll be able to fly through some of the points that I was going to make. I also think, in addition to the things that are happening today that could have an impact, that there's also things that I think the insurance industry could do to help decarbonize the built environment. So I'm going to touch on a few of those bits as well today. So if we move on to the first one, reinstatement, no longer simple like for like. Well, Cos has already touched on this one, that rebuilding works that obviously have to go through planning, have to align with the modern day standards that Cos was mentioning there. So this becomes a particular challenge for older properties that now have to accommodate things like extra insulation in the walls and roof and so on. And you may have to obviously accommodate that extra insulation and other bits within the existing footprint of the building. So in essence, things like internal room sizes could be impacted. The real challenge here is kind of trying to keep up to date with those latest standards and also having a view in terms of what those standards may be in the future, which is probably another reason really why a regular reinstatement assessment should be conducted, because things are changing rapidly within this space. So I think we've touched enough on that one, Rich. If you're controlling the slides, I'll raise my hand and sort of, you know, give a click, and we'll see if we can time it perfectly in terms of slide transition.
Don't worry, we're
energy transition is introducing cost volatility into reinstatement, and again, Cos has mentioned this. So making sure that we consider the true impacts of incorporating what we call transition materials and systems in our rebuilding assessments. So by this, we are talking about the PV panels and the air source heat pumps, Cos, that you remembered, or air source heating. I'll just call it for simplicity. These are all common retrofit items. Is the real challenge that we're facing. So they're not just being used in rebuilding sort of activities. There's huge sort of industry, government grants, and all sorts of things that are encouraging the use of these systems in building against the whole sort of building stock that was sort of talked about earlier. So we are, as Cos mentioned in the indexation sort of section, we should be expecting some real price volatility on some of these items as there will be increased demand and unfortunately, I suspect, limited availability. And that availability can also obviously cause further delays when it comes down to not being able to get those things on site as well. So it's not just the initial price of buying the things. There might be an impact in terms of the construction phasing, the sequencing of the projects, because you just can't get hold of some of these things. So hopefully. No, failed. Let's try again, Rich. There we go. Thank you very much.
There's a
Climate-
delay, by the way, so I click it and then
Oh,
it
is it? Oh, okay.
Yeah.
We'll blame it on the technology. I like that. Climate risk modelling and resilience are reshaping build-back decisions. So incorporating an element of climate resilience into what we build back is obviously another factor that we should be considering. We are becoming more sophisticated at modelling risk, understanding some of those those extreme weather patterns that was mentioned earlier, and hopefully using that to influence what we're going to build back to make sure that things are a little bit more resilient in the future. So, the flood barriers, water resistant materials on the ground, and so on and so forth. So there's an element that we need to be thinking about there in terms of sort of resilience going forwards. He's raising his hand again.
That was pretty good, I think.
Yeah, I think we're getting better. The insurance industry is an evolving role in innovation. So at this point, I'm going to move not onto a stand on the soapbox moment. Don't worry, but there is more things that the insurance industry could be doing to facilitate decarbonising within the built environment. So in terms of innovation, allowing buildings of a non-traditional construction method to obviously be insured without adding too much of the premium is one of the easiest ones for me to say, and probably the hardest ones for us to implement, I guess. We're in an age of rapid evolution and technology in particular. By technology, I'm not talking about AI for the first time in a while in one of our webinars. I'm talking about materials technology specifically. So thinking about your self-healing, your carbon absorbing materials, the rate of evolution in the material space is quite breathtaking. And as an industry, we need to find a way to be confident of the risks of integrating some of those new technologies that obviously aren't as tried and tested as the more traditional brick and tile construction. We should be allowing the choices of materials to consider their carbon impacts, not just from the carbon associated with the manufacture of the material, but also once those things are embedded in the building, their ongoing operational performance. So the challenge that we have is how do we encourage this in an industry, especially as often lower carbon material alternatives to traditional can command higher prices, or in some cases lower carbon upfront comes at the expense of the durability of the material. And we're starting to see this in the industry, that some manufacturers who are trying to reduce their carbon numbers for their products are actually having to change the DNA of the material. So in essence, it is having an impact on the durability. I suspect the answer of this is likely to manifest over the next couple of years. We're expecting in one way, shape or form for a whole life carbon assessment to be required at some point on new buildings. I do think this will happen within the next sort of couple of years. And I think this is likely to come through either planning process or building control, mechanics yet to be determined. And unfortunately, when we all know that when we measure stuff, whatever gets measured is likely to be taxed. So I think we will start to see financial incentives for trying to do some of this sort of lower carbon optioneering on our projects going forwards. So as an industry, we need to start to think about this now and get ready for it. If any of you have had the pleasure of joining us on one of our sustainability and carbon related webinars in the past, you would have seen that BCIS has been on this journey for quite a while, and we are trying to actively encourage the industry to measure cost and carbon at the same time. If this is an area which is of interest, please obviously drop some notes down in the comments or throw some questions at us, and we can cover this in a bit more detail, specifically related to insurance. We do have the ability to do more ourselves as a company within BCIS, as well as the industry adopting and hopefully making decisions based on lower carbon sort of going forwards. Did he see my hand? No, he didn't.
It is. It's already done.
Oh, is it? Sorry.
Yeah.
It's my poor eyesight. Sorry, sir. Thank you very much. Very quickly, whole life carbon regulation and ESG changing the rules. So ESG metrics are becoming more and more important to the value of the buildings, assets, and in fact businesses as well. We're now starting to see the inclusion of ESG in global valuation standards from RICS as an example. So ESG measures are really important. The ESG measures that in particular I'm talking about here are the emissions that should be reported when rebuilding works are being undertaken. The contractor responsible for the work will be reporting the emissions associated with the materials and the construction associated with it within scope 1 and scope 2 again for the contractors sort of doing the work. But scope 3 should be captured and reported by the insurers themselves. And this is something that may not be known particularly well. And again, we haven't got time to cover it in any detail today, but if you wanted to hear more about this, would be delighted to do sort of a follow-up session on it. So I think we'll leave it there because of time, Rich. I haven't done the topic justice in that amount of time, but you know, if people have questions, be delighted to pick them up.
Absolutely. Okay, lovely. No, thank you, James. I think you filibustered beautifully there. So thanks a lot for covering there. The next topic, and I promise you we are trying to close up, folks. So finally, we just wanted to look at how all of these challenges and opportunities can be distilled and communicated to customers and clients. Well aware we are running over, so I will be as quick as I can. So I'm just going to ask the panel for one very quick top tip on how we can all focus more on communicating under insurance risks more clearly to clients and customers. So Cos, I'm going to quickly start with you.
Sorry, Rich, I should have anticipated this. Yeah.
I thought
Okay,
I knew
I'm just going to make it just going to make it very simple. It is to make sure that your customer understands what the sum assured is and what it isn't. It has nothing to do with market value. It has nothing to do with inflation, house prices. It is a construction issue, and it is got to do with the rebuilding costs that go into the construction. That's my top tip there.
Brilliant. No, thank you, Cos. That's a really important point. And it links directly to the wider theme today, I think. So the risks are often not obvious until you hit the claim. James, carbon and sustainability. Is there an area where communication is becoming more difficult? What would you say your tip is?
Yeah, there's quite a few tips, but if I distill it to one simple one today, it's probably set expectations early that like-for-like reinstatement is no longer as straightforward as we may have assumed. So historically, people have thought of reinstatement as rebuilding what was there before, but the reality is that sustainability pressures and changing materials, evolving building standards, resilience are increasingly going to shape what a reinstatement project looks like in practice. This will obviously affect cost, timeframes, complexity. So when communicating with clients, I think it helps to frame carbon and sustainability not as something abstract anymore. It's entwined. It's directly already influencing real world reinstatement decisions. So yeah, the key message is that even if customers aren't asking for a different rebuild approach, the supply chain, compliance, environmental, materials landscape may push that reinstatement away from a simple replica. So the most cost-effective communication is probably to treat sustainability as a practical cost driver, not dismiss it as a future issue.
Brilliant. Okay, great. Thank you, James. And so I'll finish with something from a commercial and customer communications angle, I think. So my top tip is don't frame under insurance as a technical detail. Frame it as a customer outcome risk. So because most policyholders don't naturally understand what insurance means in practice, so they might assume that the insurer will just sort it out at the event of the claim, or they might think index linking is a guarantee that the number is right. So, or they might simply prioritize affordability because the premium feels like the immediate risk. So, and when this is consumer duty, it's practical relevant. So underinsurance is often a form of foreseeable harm. We know customers don't read every detail of policy wording. We know they anchor to the number that feels reasonable, and we know there's a tendency to treat the sum insured as just another box to tick. So the challenge is to not overwhelm customers with technical information, but to communicate clearly what the number actually represents and what the consequences are if it's wrong. Okay, so just on clarity of communication risks, I was just going to say a little bit about this, but we're so far over time. I just wanted to flag again that we're producing a crib sheet on this topic, which we'll send out to everyone who's registered for this webinar. We are going to skip over questions, I'm afraid, and we've had a lot, so we will try our hardest to get every single one tackled. So we'll pick all of these back up with you. So I think it feels a good time to wrap up. So we'll get these covered for you now, folks. But I just wanted to very quickly, first of all, say a huge thank you to James and Cos today. Thank you all for joining. And we'll see you at our next event, hopefully.